Let's dive into the world of S corporations, a special type of business that can help small companies avoid double taxation. An S corporation is a business that elects to be taxed in a special way. Normally, businesses are taxed at the corporate level, and then shareholders pay taxes again on their earnings. That's double taxation, and nobody wants that. With an S corporation, the business doesn't pay corporate tax. Instead, all profits and losses flow through directly to the owners, who report them on their personal tax returns. This makes S corporations similar to partnerships or sole proprietorships when it comes to taxes. But of course, there are rules. A business must qualify and elect to be treated as an S corporation by filing with the IRS. How does a business become an S corporation? When a corporation is first created, it's automatically classified as a C corporation by default. If the owners want to change this and become an S corporation, they must 1. File an election with the IRS. This tells the government they want to be taxed differently. 2. Follow the specific ownership rules, which are: S corporations can only have 100 or fewer shareholders. Shareholders must be U.S. citizens or resident aliens as owners, no foreign investors. There is one class of stock. Everyone has equal ownership rights. If the business meets these rules, it can enjoy the benefits of avoiding corporate taxes while still being a corporation. Let's talk about how businesses get their initial funding. Owners often contribute money or property in exchange for stock in the company. The IRS allows these contributions to be tax-free as long as the contribution is property, not services. It is only in exchange for stock. And the owners getting the stock own at least 80% of the company after the transaction. If these rules aren't met, the IRS will treat the contribution like a sale, and the owners might have to pay taxes on it. When does an S corporation pay taxes? Normally, S corporations don't pay taxes at the corporate level, but there are some cases where they do. Let's look at 3 situations where an S corporation could owe taxes. 1. Last in first out inventory. Recapture tax. If the business used the last in first out inventory method for inventory as a C corporation, they might have to pay taxes on the difference when switching to an S corporation. Why? Because last in first out inventory allows businesses to report lower profits on paper. The IRS doesn't want companies to avoid taxes just by switching classifications. 2. Built-in gains, big tax. Imagine a company that used to be a C corporation and then switches to an S corporation. If they sell assets that went up in value, the IRS might say, wait a minute, you can't escape taxes just because you changed your status. If an asset's fair market value is higher than its recorded value, the company might have to pay a 21% tax on that built-in gain, but only if they sell it within 5 years after becoming an S corporation. 3. An S corporation can be taxed on its passive investment income if 2 conditions are met. 1. The S corporation has accumulated earnings and profits from when it was a C corporation. 2. More than 25% of its gross receipts come from passive income, which includes royalties, dividends, interest, rents, and annuities. If both of these conditions apply, the excess passive income is taxed at 21%, which is the corporate tax rate. Pay attention that if an S corporation has too much passive income for 3 consecutive years, the IRS can terminate its S corporation status and force it to become a C corporation again. This means the business would lose its tax advantages and go back to being taxed at the corporate level.